All right, hello to everyone. We are now online. So we have here offline people who have joined our meetup, and this time we are also having people who are joining online. This meetup, just a few things, a few words about the organizers. This meetup is organized by InMind platform for startups, for innovative projects, for investors, and for the experts. We mesh together the projects from all the different industries, the investors from all the different countries, and service providers who can help startups, who can help projects to make their businesses live. And today, our meetup is about blockchain trends, what have changed during the last 4 months since our last meetup. We will also discuss the ICO trends, what is happening with ICOs currently, what is happening with cryptocurrencies, and feel free to ask questions because, Dennis, we have today the audience of, as I mentioned to you, very different people from different industries, those who have already worked with blockchain and those who hasn't learned much about blockchain. So it will be great if you could also explain some basics. But before we proceed, I would like also to share with you some information about the Blockchain Leadership Summit that we are organizing in the end of November in Basel. You can read more information on these leaflets. Feel free to process. This is the event where the leaders of the industry are coming from the different countries. We will have discussion during these 2 days about different implementations in healthcare, because you know the Basel will have lots of healthcare companies, so they will come and speak about the use of blockchain in their products. But we will also have lots of startups who will be explaining how blockchain helps them to develop their business. And for those of you who, like, normally we do it for our loyal attendees, we also give discounts for the tickets. So you can just see the special promo codes. You will also have them in the letter after this meetup. So those are the promo codes if you want to attend the event. And for our loyal attendees, we give 50% promo code, which is valid today and tomorrow, and 25 until the end of this week. So I think we can start now. We can start with the presentation of Dennis. And as I mentioned, first there will be a presentation, and then we will also be able to ask questions. So Dennis, can you see everyone? Can you hear us? Is the connection good?
The connection is okay. There are sometimes some minor freezes, but I believe that's okay. If anything starts interrupting, just give me a sign.
All right, perfect. So I will just put you on the full screen so that we can see you better. And please go ahead, Dennis. Just a brief introduction. Dennis Sarkar is an ICO specialist. He has analyzed more than 100 projects, ICO projects, and he is also very experienced in tokenomics, what he will explain to us today. Please, I'm giving you the word.
Thank you. Okay, hello everyone. As just another brief self-introduction, I would just like to tell you that there is currently no such thing as, you know, as an ICO specialist in the traditional meaning of that thing. You know, I'm just. Is everything all right with the sound? Yeah, great. The thing is that I am.
Dennis,
yes?
Is it okay with the sound? Or, Dennis, can you try to speak without headphones?
All right, I'll just switch to the camera. Okay.
We will check. Maybe it will be better like this.
Okay, is it any better now?
No, no, it's the same.
It's the same. That's weird. And now?
You can start speaking. We will tell you if it's better.
Well, so how's the sound now?
Can you try without the headphones like we tried?
No, the headphones just give me the sound, but the microphone, I switched to the camera microphone instead of this one. So this one is not supposed to be recording.
So let's try with this one. Okay.
All right. Well, as I was just saying, the thing is that currently we are just considering the possibilities of the blockchain implementation to all the possible spheres of businesses, finance, commerce, and even some social spheres like insurance, healthcare. There is definitely this thing about the digital ID. We will get down to that a bit later. In my scope of work, I used to work for a couple of ICO startups this year. Before that, I joined Kick ICO for a while. It's just a platform for fundraising, which is intended to standardize the ICO fundraising processes. But for those of you who might be just unfamiliar with the entire concept, I'd like to start with a short presentation. Try not to take all your time, and it's going to be somewhere here. Just a sec. It will pop up on the screen. I guess it will pop up on the screen. Okay. Once again, we go for that. And here. Okay. I hope you all can see the first screen. Well, it's just because we're going to talk about blockchain and the development trends of the 2018. Okay, so originally the technology is pretty simple to understand. Of course, there are a lot of aspects of technical development, but we're going to just talk about the very origins of that. Is there anything wrong?
Yes, Denise, you can continue. We're just checking the dynamic because it seems that the sound comes not from the correct place. But you can continue.
All right. Oh, so there's a bigger screen somewhere. Right now I'm looking at you. Okay, I got it. All right. So let me just tell you in brief what actually blockchain is. Might be many of you are familiar with that. For those of you who are not, well, let's just consider it this way. Think of a ledger, like a regular ledger you use in your company for bookkeeping. Like you keep records of the last year to report it, and therefore it's basically a record that you can rely on. It's a record that you can rely on, and you can use it for reporting. You can use it for public reports. You can use it for actually checking the data yourself to see. Like any accountant is basically a historian of your company. So what is blockchain? It's a network. There are many different blockchains right now, and any blockchain is just a network of nodes, so to say, computers or servers that synchronically store your data, your reports, on all the servers connected to the network. Like if you compare it to, for instance, well, everyone uses Google Documents right now, right? It's when you create one document, like a regular text file, that you can share with the others, and each of you can modify it. Now, think of what would happen if everyone had their own copy of the document connected to not just one Google server, but connected to all the servers. Therefore, it would mean that anytime you just add another line to your document, it modifies all the other copies of the document, and it modifies the data on all the servers that are there in the network. So that's pretty simple. what it gives us are several values that are unavailable with what we currently call centralized systems. Well, you know, blockchain is normally considered a decentralized technology. Well, that's because it's opposite to the current state of centralization. For instance, your bank is a centralized authority. Therefore, you have your account in your bank, and your bank has the imperative decision power of, let's say, freezing your account, or withdrawing or restricting withdrawals from your account, or just probably arresting your entire account because of some suspect or whatever it is. I mean, we're talking about extremes, but that could happen. And the thing is that there's going to be just one party, your bank, that will control and that will have the power of decision making. Now, the blockchain technology actually introduces a completely opposite vision of that thing. What happens is that no one has the control and authority. It is basically the connection of all the computers, of all the nodes united in one network that have the, not to say the decising power, but the power to realize the decision. Therefore, when you want, let's say, to add any data to the network, oh, what's that?
Denise, the sound just stopped.
Oh, since when? My gosh. Why did it?
Are you here with us?
Yes, I am here with you.
So it's not on our side.
Yeah, it's okay. And what about now? No.
So let's see. It looks like what we. Yes, it seems that it's not on our side, but we're fighting now with technology. Okay, Denise is back now. Denise,
Is the sound back?
can you say something?
I am saying. So is the sound back?
Strange sounds.
Hello?
We do not hear anything.
Well, it's
But
totally not on my side.
Okay, actually, this is this thing. Okay. Denise, say something?
Is it better now?
Okay.
I'm back.
Now it works.
Well, so where did you last catch me?
I don't know why this. Yeah, maybe the connection is. Just 1 second. We're trying.
I don't see why it's.
Say something, please.
Hello?
Okay, this is from here now.
From where? What's that?
Wait, now you're speaking from the camera. Maybe it will be more stable, even, no? Or it's not enough.
Is it?
Okay.
Well, I don't know. Give it a try.
That is a bit worse than it was before, right? It's not loud enough, right? Say something.
Hello. I hope I am loud and clear.
Okay.
Am I not?
Let's continue with this one because there is something with the speaker here. So.
Well, I see. Well,
it was on our side. It's not on your side, basically. All right. Yeah.
Okay. Well, I'll just get back to that from where we stopped. Well, I hope you didn't miss a lot. Anyway, what I was saying is that any network, any blockchain network, just allows us to store synchronized copies of the data that we upload there. And what happens is that when we want to add or to moderate some data on the blockchain, we access it, and it has to be approved by all the other participants of the network. Now, a simple example that you could think of is, for instance, if you, let's say, think about, uniting with your neighbors and just creating your own currency, like your own state, just within your neighbors, like just the several houses in the street, you just unite into a separate state. And there, you don't use the external currencies, you invent your own. But to make sure that no one cheats, because, well, when you use homemade currencies, when you just clip it out of paper, anyone can fake it. You all, first of all, write down how much each of you has. And then when you deal with your neighbors within your newly created state, you change the data into your notebooks. And so does each of you. This is basically the idea of the blockchain. Everyone has a copy of all the changes and of all the data that is synchronized in the network. What it gives us is actually, first, control of the information. We can definitely know who and when decided to moderate it. And secondly, what happens is that we can always track down exactly the change that was either fraudulent or at least suspicious. So let's say if with a regular bank account something happens and you will be unable to find the roots of the fraudulent transaction in, like, let's say a month or something like that, with the blockchain it will be stored eternally, forever, and you will always see who authorized that transaction, who actually applied for that transaction, and what happened further to it. So it's basically a distributed trackable ledger. To put it simple, we can just take a look at the slide there. It's a combination. The technology is a combination of FidoNet and Torrent. It's a distributed system of nodes and a system of distributing information in bits. Now, getting down to crypto, one of the most probably common and well-known applications of blockchain are crypto. Everyone has heard about Bitcoin, Ethereum, and many others. We hear about some of those are stable coins, some of those are regular coins, some of those are not coins at all. But anyway, we all know about them. We have all fascinated the extreme growth of the 2017. Many people made fortunes on that. Many people tried to continue to make fortunes with the Bitcoin in 2018, and they screwed up. Well, apparently because it was quite artificial, the growth. Now, getting down to cryptocurrencies in general. Cryptocurrencies are based on the blockchain technology, and they use the distributed ledgers just as you use your bank account. They use sort of wallet accounts, well, sort of bank accounts, distributed all over the network. So everyone knows exactly the entire history of every wallet within the network. Like, everyone can just monitor it. The only thing that protects us, our personal data, is that all of those wallets are anonymous. Therefore, the only way to access it is not via any ID or passport. It's via your password, your key, your private key. Once you lose it, your account is gone. No one will be able to access it. All that you have had in that account is basically stored there forever. You will never access it back. There is no super powerful party. There is no central bank, and there is no imperative decision maker who can say, okay, yes, that wallet belonged to this guy, and therefore, even though he has lost his private key, we can give it back to them. No, it's going to be there forever. So it's basically like torrents, but instead of small bits of files, movies, or documents, we are sending coins. Well, it's not a physical coin. It's not made of metal. It's just a file that has some data encrypted there. So every coin belongs to some wallet. Once you want to transfer it to, let's say, your friend or to a business to pay with the coin for something, you apply for a transaction to the main network. And within the main network, those computers, nodes, and servers, they authorize the transaction, they confirm it, they verify it, and then they process it. Depending on the network, there might be different stages of that. So let's say the Bitcoin network requires at least 7 confirmations of one transaction. So it's quite secure. Definitely your Bitcoin will not get lost. It will not get somewhere where it's not intended to, unless you use one of those, mixing services or something. But within the network, it is extremely secure. Without you losing or somehow compromising a private key, no one gets any sort of access or any form of access to your wallet. And what's even more important, let's think about the future implementation of those cryptocurrencies. When we regulate it, when we actually commonly apply it for life, and we finally apply some digital ID to our wallets, so they're not fully anonymous, but at least they are always tied to us. The greatest thing is that each transaction is logged by every wallet. So even if, let's say, as compared to the bank story, the servers of the bank crash, the main server crashes, you do not have any access to your account. You cannot process any transactions until they fix it, and if they fix it. Or let's say, if for some reason there is a hacker's attack on your bank, it might go down for actually ever, because it will just lose all of the money, and that's it. Now, with the blockchain, the thing is that since a copy of the ledger is distributed over the entire network, so every wallet stores the entire script of all the other wallets. Therefore, even losing 50% of the network, like let's say, I don't know, those computers just die, you don't lose the network, you don't lose the data. As long as there are at least some computers, just several of those, operating, you will still sustain the network. So as a result of this technology, we have reliability, we have control and full monitoring of the network, and we have transparency. So no fraudulent transaction can happen, no hackers attack can happen. Of course, there are now rumors about the 51% attack and more, but it's not actually coming plausible anywhere soon. Now, this was just a brief introduction for those of you who are unfamiliar with the thing. Now we're going to talk about yet another story that has become popular with, within the last couple of years, which are tokens. Many of you have heard or seen ads, or probably, I don't know, at least know somebody who used to speak about some ICOs and therefore tokens. So what are those tokens, and why do we not call them coins? The big deal is that a token is just like a coin distributed within some network. Well, most commonly, at least over the 2017, it was the Ethereum network. Many businesses, many companies, many projects and startups, they introduced their tokens. They sold them for millions of dollars, really. In the 2017, there was about $100 billion collected by just a few projects in a glimpse of like an hour. When they started their sale of their tokens, they got sold out immediately. Then overall, the sales of the 2017 reached up to $1 trillion. So it was an extremely interesting market for many. And people were just buying tokens. Investors, professional and private, investors, funds, pools, they were all trying to get a share of it. And the greatest thing was that people did not really even know what they were buying. And this is what we're going to talk about today. First of all, tokens are not just coins like Bitcoin or Ethereum or others, because they are kind of they're kind of built upon some existing network, some existing blockchain. So within the Ethereum network, you see there are some tokens that are actually not independent. They cannot exist without the network. So they're highly dependent on, well, let's say it's the Ethereum network. The funny thing is that the transaction fees of those of the networks do not actually let us use tokens, those ICO tokens or TGE tokens or whatever. They do not let us use them as cryptocurrencies. They limit us to using those tokens within just one startup that sold the tokens to us. Because within every network, the transaction fees for actually processing any form of transfer are paid in the core coin. So with the Ethereum network, it is the Ether. With the Bitcoin network, it's Bitcoin, and so on. Now, in this case, if we cannot freely use it as cryptocurrencies, just as, you know, digital dollars or something, what's the application of those tokens? Well, it was pretty simple. A lot of projects, startups all over the world, they introduced their economy models in which they said that it would be extremely lucrative and financially beneficial for each of us to start, instead of using, you know, Bitcoin or actually just dollars or euros, to start using their tokens, because their tokens would grow, and they would grow in price immensely, and many of them actually did. Now, to get deeper to that and to understand the phenomenon, well, let's just kind of speculate about the whole concept of ICO or TGE. On the screen, you can see there are a lot of abbreviations: ICOs and TGEs and STOs and IPCOs and IECOs, and all of those are some forms of token or coin sales. That's when a startup comes out and tells you, hey, why don't you want to buy my coins? They're going to give you a lot of advantages and they're going to make you a fortune. And quite often it worked. The thing is that it didn't actually work as a healthy business. An ICO, so an initial coin offering, is basically as far from a traditional IPO as we could think of. There are many different stories when a project just used, you know, what's so-called a white paper, just one document which described some concept in brief, saying we're going to develop a flying taxi and you buy our coins now and the company will make billions of dollars and so will you. And, you know, they just made one piece of paper saying that we will build a flying taxi. They collected millions of dollars. They never developed a flying taxi. They never developed even a regular taxi. They never even got to anything close to Uber, but people spend their money. Now, a TGE is basically a token generation event, which is just the same story as the ICO. It's when someone creates tokens, preferably, mostly, to sell it and somehow get it distributed. All of these cases that we have seen in 2017 were pretty nasty, I'd say, because they were all hype-driven. People kept buying some tokens that were highly advertised. It was getting close to the Ponzi scheme as much as it actually could. And then we understood that, okay, this thing is not going to work. It's full of scam. It's full of deception, it's full of fake advertising, and there has to be something changed. And people started to introduce some more fair models of value distribution. So they introduced some STO, which is the security token offering, trying to get it as close to the traditional IPO as they could. So with the reports, with the dividends, with the shares of the company being actually tokenized and then sold. Or let's say IPCOs, which is a Dutch concept. They developed it, and basically it is also close to tokenizing the actual shares of a company for sale. Or now I can hear about IECOs, which are the initial exchange coin offerings, when people, instead of calling the price of their token, saying, I want to have $200 billion for my flying taxi concept, and you can buy it, you can buy the tokens. Instead of that, they immediately throw their tokens at the exchange. So to try to bring it closer to the market equilibrium. So in general, boiling it down, we can say that there are basically three types of tokens in the world. The most popular are utility tokens. This is the most limited thing, and this is in very many cases the most useless purchase you can ever make. And this is in many cases, it is the most useless economy model that you could think of applying to your own business. A utility token is, I'll just give you an example of the same flying taxi. So I tell you, tomorrow I will establish my flying taxi company. Now I have a concept on a piece of paper, but tomorrow I promise you it will already be as close to flying and taking passengers as it can be. And actually it's not even close to any sort of MVP. But then I tell you, okay, for my extra unique service, people will have to purchase tokens. They will not be able to pay in dollars or Bitcoin or euros or pounds or sterling. They will just not be able to do that. They will have to purchase my tokens first to use them as, well, if you'd like, tickets. And I tell you, you can buy it now for cheap, because tomorrow the increased demand for my flying taxi will drastically drive the price of the token up, because of the limited supply of my tokens and of the increasing demand. People will generate the higher price for the token. You think, okay, that's a great idea. I buy it now cheap, I sell it tomorrow high. Well, very rarely that happens. The thing is that mostly when I say I want $200 billion, I already overestimate the market a lot. There is not enough demand for $200 billion of flying taxi services. It just doesn't happen. Therefore, when you buy the tickets, these tokens, you do not get any dividends or any rights or any share of my company. All you get is a ticket. Now think of going to your local bus service and buying all the tickets that they have printed for the next year, and then try reselling it, making, I don't know, a 10 times surplus. It just doesn't happen. People will ignore it. People will use another bus service, or people will just not be interested. Or, which is even more often, the bus service will just print new tickets. All of that happened to the utility token market. And then Switzerland, for example, came with their classification of tokens, and they divided those in three different types, which were the utility tokens, the ones that are probably the least interesting for us, the security tokens, which are basically the assets of every company that wishes to go ICO, just tokenized, therefore stored in a distributed ledger, and the payment tokens. The payment tokens were a bit different. That's basically when you just use this token to process some transactions within some, I don't know, online store or platform or marketplace or anything, where you just use it as a regular currency. Now, that's also quite a questionable thing. Why do I need an artificial currency if I already have a lot of existing currencies? But the most interesting was the security type, because that's basically where blockchain shows its advantage. We tokenize assets, real assets, dividends, rights, voting rights, shares. We tokenize it, and therefore we protect it. We do not make it better. We don't make it cheaper, or we do not make it grow faster, but we just protect it. No one can actually fake your shares of a Google company if it's stored on the blockchain. The blockchain will definitely show all the transactions within the network, and you will always have your protected right of ownership. That's where it comes in place. So what's funny is that the blockchain allows us to tokenize literally anything. Now we can see there are a lot of concepts of time tokenization, of attention tokenization, stuff like that. Well, we are all familiar with the famous YouTube model, right? When people make money on creating great content that attracts a lot of viewers. Well, the blockchain allows us to store any form of data, and we can develop programs, applications, distributed applications there to process the data. So it will allow us to tokenize literally anything. That's the great side of it. Now, Let's probably think about applying tokenomics to businesses. Commonly, people do not prefer to tokenize assets because that means sharing their dividends and rights. They don't want to do that. They want an easy catch. Therefore, usually they tokenize nothing. They tokenize air. They tokenize the function of money. Therefore, for instance, if you think about any commonly heard ICO of the 2017, what they promised to you was, okay, you will use our token as a form of money within our marketplace or service, and other people will do so, and the token will grow, and you will make more money. But the thing is, it was not linked to any measure of service or actual profit of the company. It was just that you could pay with it. So it was like making artificial money on top of a digital money system. It was just as useless. And apparently, the ICO market revealed its main big problems, which were, first of all, the intransparency of fund spending. You could not really control any of those startups. They did not report. Unlike a traditional IPO, they did not report anything. They just ignored it. They just said, okay, I will spend $40 million and develop a flying taxi service for you. Well, then you actually ended up in the end of the day seeing those people buying Ferraris for your own money, never developing anything. That was the most common case. The second problem was that most investors, probably accept those early seeds who actually had a lot of control of the company. No one had any kind of control of what will happen to the startup. So those startups were making free money from nothing, from air, and they were never reporting. They were never actually given any right of control to their investors. And the main problem, the main market issue, was that the common story with the ICOs was that they overestimated the price of their token highly. This is why very often on the exchange, like upon the very first day of trade of any token, you saw the price, the initial price of the token, let's say at $1, and at just the end of the day, the token going below 1 cent. Well, that was because the company, during their token sale, had already squeezed out all the demand out of the market. No one else was interested. People were looking for some extreme growth, and they were just preferring the companies that had no or little potential or intention to develop, but that spent a lot in advertising. So those were all bad cases. Those were all bad stories. Now, we're going to talk about how we actually healthily introduce tokens to a business. And what we have to think of is that depending on which business or which form of company we're speaking about, we have to consider some unit or unitary asset of the company. It could be time measured in minutes. It could be profits measured in dollars. It could be attention of your audience measured in minutes spent on your YouTube channel or whatever. But that all can be tokenized, and it all can be stored within the distributed ledger. Now we can find a lot of concepts of that form of application without any form of ICO fundraising, just companies using the tokenization protocol to keep the record, to make it easier for their businesses operate. As Kate has already told you, in Basel on November 23rd, 24th, we'll have a lot of startups and companies presenting their visions of how they tokenize their assets, not necessarily shares, possibly anything. What actually is great about it is that the 2018 has eventually started to show the healthy trend. The companies are now beginning to consider tokenizing something real, tokenizing something of real value, probably unexpectedly to us, but value. And in the Blockchain Leadership Summit, you will be able to learn about it better, but the examples will follow anyway. Now, the next slide, I'd like to switch to that one. Yeah. As basically, as I said, the 2018 has started to show the healthy trend. We are getting rid of traditional ICOs, and that's just brilliant. That's amazing, because now, you know, if in 2017 we could say that those were the blockchain businesses that were ICOs, now we can see that there is a big distinction between the blockchain-based businesses and ICOs. As I said in the beginning, blockchain is a distributed ledger technology. It's a technology that lets us distribute data and synchronize it between many different parts of the network to store it safely, to store it immutably, and to store it forever. Now, ICOs, token generation events, token sales, and all of those forms of fundraising using the blockchain are just one way to use it. It's not the complete implementation of the blockchain. It's just one way to use it. Basically, before we had ICOs, we had Kickstarter, which without any form of blockchain allowed you to raise some funds. That's what an ICO is. An ICO is just fundraising using the blockchain technology. Now, let's get back to the blockchain technology itself and forget about ICOs for a while. The blockchain technology can be applied to any business and let you truly benefit from that without any form of token at all. As we can see on the examples of many large corporations, really big ones that had been operating without any implementation of blockchain before. So it's not that they made their millions and trillions of dollars now when they sold their tokens. No, they have their business established. They have had them established for a while, and now they started to consider the implementation of the blockchain technology to store the data safely and to be able to process it fast from any point of their network. And those are, for instance, the Bank of China. The Bank of China uses it now to keep the track of all the clients of the Bank of China. So let's say the credit history, the rate, the credibility rate of a person will be stored on the blockchain. No one will be able to manipulate it. It will be stored there reliably. Apple has filed several patents of their use of the blockchain technology to keep some processed data of their clients on the blockchain as well. Wells Fargo did the same. It's another big bank that also uses the blockchain to provide safe transactions between their servers. So not just using the digital IDs of their users, but they also use it for safe transactions. So let's say no one can hack it. No one can just out of a sudden somehow get an access, authorize a fraudulent transaction within the Wells Fargo ledger. Toyota also uses it for processing their client personal data safely and for their logistics. Samsung, in the next year, well, they have already announced that in the next year they will introduce their next ledger technology that they will use for tracking supply chains. Well, Samsung is one of the major producers and manufacturers of Asia and the world, and they're using it now to control their shipment, to control their supply chain tracks. And why all of them do that? Well, yeah, there's another example that I put here that came to my mind, which was Walmart. Walmart used the blockchain technology to make sure that the meat you bought in Walmart was fresh, because no one could fake the sticker if it was signed to the blockchain. The blockchain would always reject any fake info. So you could easily check, and they could easily make sure that throughout their shipment systems, throughout their logistics, the meat that you bought was definitely fresh and good for sale. Now, why am I giving you all of these examples? See, none of these companies actually used any form of ICO or tokenization or selling their tokens. They all use the blockchain as the technology to control, monitor, and update their information. And this is the major application of the blockchain: processing data, processing information, having an access to that information from any node of the network, and having it reliably stored, eternally stored, and immutably stored, being invulnerable to any hacker's attack. Being fast, operating on many computers simultaneously, it gives us new possibilities of data control. This is the main aspect of the blockchain implementation. So, speaking of the 2018, and definitely getting to yet another introduction of the Blockchain Leadership Summit, we will talk about the modern trends of blockchain implementation. And I can tell you these are the ones that will be discussed and presented during the summit. And I will just use another minute of yours to introduce you to the main aspects of those. So the social impact. Definitely getting people easier storing their data, processing their data easier, cheaper, making cheaper transactions, controlling everything on the blockchain reliably. And that can be definitely anything. For instance, now, in many countries, including the developed ones, you hear there is a lot of political noise rioting about every given election. Anytime in the United States a Republican gets elected, the Democrats yell. The other way around, the Republicans cry. Well, and they keep saying that it was all unfair, it was all unreliable, it was counted wrong, the people were corrupted and stuff like that. Well, definitely I'm not anyhow penalizing the United States for that. It's the common situation for all the world. But the blockchain can solve it. Without any tokens, we can distribute special programs called distributed applications over one network that will process the data, that will process it autonomously in a decentralized way. It will keep it stored everywhere. So therefore, you go to vote, you vote, and your vote is definitely counted right. It's never doubled, it's never ignored, and so it is with every vote. And then the distributed application tells us the result of our voting. This is the most fair way, and this is what we can expect in the nearest future. The other aspect is, for instance, for many people that are, let's say, excluded from the banking services at all. 50% of our population on the planet, just for you to notice, do not have any access to the banking services at all. Like, there are a lot of poor countries, and mostly banks are not interested in developing their infrastructure there. The blockchain can solve that. It lets you combine and utilize a lot of data, a lot of personal data, a lot of information and report to give you some credibility rate of each person, and therefore we can bank the unbanked people. We can actually include them into the financial services and the financial industries of the world. We can, as I said, as many big corporations did, use blockchain for tracking systems. Personally, I worked in a startup that was developing tracking systems for the pharmaceutical industry. And we came to a conclusion that using the blockchain in those makes it significantly cheaper for any big pharma to control the quality of drugs, the quality of supplies they have, and to completely control the entire supply chain network. Just as well, companies using the blockchain can store their records on public. Therefore, we avoid any form of fraudulent misinformation. Insurance and healthcare definitely would benefit from that, from the same sort of records and reports. And as I said in the beginning, we can have completely new types of assets, such as we can store our time, and we can actually add some value. We can link some physical value to, let's say, the time we spent in some social networks, and that data can be also stored in the blockchain, providing us with some new business models. So these are all the big possibilities, and luckily in the 2018 we can see that the blockchain market has started to actually get towards this healthy development. Instead of those ICOs and tokens, what we now see is the trends of real application and development. So just as 10 years ago we were introduced with the concept of smartphones, and now we have them working for us, just like that, in the nearest future, we will use the blockchain as the second or the third or the fourth generation of the internet. Okay. Basically, this is what I wanted to share with you. Definitely would be glad if anyone managed to follow throughout the entire presentation, and would be glad if you have any questions there.
Okay, thank you, Denise, so much. Thank you for the presentation. So now we switch to the question part. And I will let first the audience here to ask questions, and then I will check what is happening in the chat, because the chat was pretty active. We have even some people watching from Australia, where it's 3 a.m. So maybe we start with the question from your side. Do you have any questions? Yes?
What is the environmental impact of blockchain? Because I understand the information is being duplicated in many servers. So we have an idea of the environmental impact. So we need more servers, more electricity.
So Denise, the question, so that you hear better, I will repeat. The question is about environmental effect, how the implementation of the blockchain and of all different servers can affect the environment.
Well, thank you for that question. I kind of completely slipped my mind. I believe what you're talking about is the proof of work protocols and their effect on electricity consumption and therefore the environmental effect. Well, yes, it's pretty bad. The funny thing is that now, just to sustain the Bitcoin network in the beginning of the 2018, the world spent more electricity than several separate states taken apart. Well, that's definitely an extreme. But it's not going to be like that forever. Now, the thing is that most modern protocols either use some combinations of consensi, or instead of using the proof of work technology, they use the proof of stake solely, so that not to consume a lot of electricity. They have different protection protocols so that we will not have to have that many powerful computers dedicated to useless calculations to sustain the network.
Thank you. Did you answer your question? But I think, Denise, you didn't explain so much about proof of work and proof of stake.
Well,
can you elaborate? Because is it clear for everyone? So could you please explain what is proof of stake and proof of work? What is the difference?
Well, to keep it short, those are just different security protocols, normally called consensi. Consensus is the model upon which the blockchain, each taken blockchain, controls how the data can be updated and stored in the blockchain. So to make all of those nodes that are connected to the network work synchronically, we have to develop some mathematical algorithm for them to follow. And to prevent a lot of randomness or fake data from being applied to the network, one of those is called the proof of work protocol, on which consensus is based on the idea that every computer is supposed to solve some mathematically complex task in order to pass to the network to add some data. This thing actually caused the Bitcoin network to stagnate quite often and to increase the price of transactions a lot. But this is just one of those possible consensus models. Instead of the proof of work, we can say there is, for instance, the proof of stake, at which the protection of the data is based not on the computer powers of all the machines connected to the network, but it is it relies on the fact that people who want to authorize transactions to the network have to store some of their real money and coins on the so-called deposit accounts. Therefore, if you somehow compromise the network and its reliability, you basically lose your money, or you at least drop the price of coins a lot because people lose their trust to the network. They start selling the coins that they are not interested in that no more, and therefore you lose your money. So you're not interested to cheat on the network because yes, you will probably steal somebody else's coins or data, but you will also lose your own. So that's one of the potential protocols. There are many that also are intended to save us a lot of electricity and computing powers, mostly in combinations with the proof of stake. And their environmental impact is basically no worse than a private personal computer.
Yeah, I'm jumping around just because I'm switching on and switching off the microphone, so it's more convenient for you to speak like this. So what's this explanation clear, or you have questions on this proof of stake, proof of work? Okay, any other questions concerning the presentation? Yes?
I have a question concerning the definition of value, because Dennis said now we can tokenize shares of companies, also attention and like time as well. I wonder what kind of value can we, what else can we also tokenize in terms of value, and also is it the direction which blockchain technology is going to take?
So the question is, what kind of value can be tokenized? So we spoke about the tokenization of shares or tokenization of time that the person is contributing to use the product or to use the network. So what other values can be tokenized?
Well, for instance, there was an interesting example developed by the ex co-founder and participant of the Mozilla Firefox team. They developed their own browser, which you might have heard is the Brave browser, and they developed a model of tokenizing your attention. Now, quite a simple one. If you install the Brave browser, you can, well, many of us use ad blocks, right, to avoid any form of advertisement or overwhelming advertisements on the web. Well, the Brave browser had this thing built in. It actually erased totally any form of advertisement. I'm sorry, I will just kill the notifications there. So what happens when you use that browser is you either eliminate all the ads from your browsing experience, or you can, let's say, highlight that you are okay to see car infomercials, fitness offers, and, let's say, travel offers amongst the advertisement. Therefore, Brave stores the data in the network, and they can target precisely those kinds of advertisement that you volunteered to see. The funny thing is that apparently Brave gets some monetization. They get some profits from the commercial developers, so that from the advertising agencies, they get some profits because the advertising agencies pay for the Brave browser to distribute the ads. And the Brave browser, for you watching those ads, paying attention to those and not killing those entirely with your ad block, pays you. So you decide that you want to see 10, let's say, ads a day. You're okay with that. Therefore, you give your attention to the Brave system, and therefore you share your attention with the advertising agencies. You let them target some relevant advertisement to you. You get paid for that. So this is how your attention can be tokenized. The same way we can tokenize the time you spend in, let's say, watching videos or something. Well, mostly those are, of course, advertising applications, advertising businesses, but we can think of more. Anywhere where your attention matters, it can be tokenized. It can be stored on the blockchain. It can be somehow made equivalent to some unit of value, and therefore it can be shared, sold, bought, recorded, updated, and given away. You're
Okay.
still muted. No, you're muted. Yeah.
Yes, because I'm trying to, to click on the microphone. Any questions from you guys? Okay.
There's been a lot of buzz around stablecoins, and I wonder if you could explain quickly how they work and what he thinks how they will develop or influence.
Okay, the question is about stable coins. So how they work and how they will be developed.
Well,
So,
yeah, I get it. Okay, now speaking about stable coins, first of all, I would like to highlight there are basically two kinds of stable coins that shall not be put together. One of those are the so-called stable coins, which are the top 10 of the cryptocurrencies, the highest price, the longest history. They're not stable at all. If you look at their volatility, it's always insane, but it's just less insane than all the other cryptocurrencies available on the market. Therefore, Bitcoin, Ethereum, Monero, Cardano, Neo, EOS, and a couple of others are for some reason considered stable coins because, well, you don't lose your entire fortune overnight with those. You just lose half of it. So it's more stable than nothing. Then another term that also is considered to describe a stablecoin is the tether technology. That's, for instance, yeah, the USDT coin, which is the tether coin of the United States dollar, is probably closer to the idea of a stablecoin itself. It basically means that someone, well, in this case, the tether company, develops their coin, and they say our coin is always going to be equal to one United States dollar. And therefore, you will have an easy in and out from the cryptocurrency market. Like you have your $100, you want to buy some bit of Bitcoin, you convert, you just buy United States dollars tethered, which are the crypto coins. You buy it, you keep 100 tethers, and then when you want to buy Bitcoin, you buy it, you exchange it, then let's say Bitcoin grows, you want to fix your profits, you buy the USDT back. Why it is used is because the company promises, and this is how far it goes. They just promise. It doesn't mean it's regulated. It's not controlled. They just promise that they will always store enough real United States dollars on the accounts to always support the rate of their coin at $1 fixed. But it's just a promise. And yes, they have not violated it yet. They have not broken their promise, but it's not regulated, it's not controlled. So it's not 100% stable just because we have no control of it, we have no guarantees. So far, it has worked like that. The idea is that you know, if you want to, the stable coins were introduced for traders, which again are speculators, and this is the form of activity which will either decrease or completely get abandoned in the nearest future, at least in my opinion, because it's not actually intended to let any real development. Instead, it promotes the idea of speculate and trade and getting profits out of nowhere, getting profits from the people's hype. And those stable coins like Tether, USDT, they were developed to make it easier for people. Instead of, you know, like you have $100 in a bill, you go to your bank, you put it to your deposit, then you go to some exchange and you buy it, and you have to pass all of those KYC, AML. Most exchanges do not actually work with real fiat currencies and with real bank accounts. So you have a lot of struggle to actually get your $100 converted to what's up? Uh, Aha, okay. Now, my team tells me that I'm still online, which is great. Okay, so I don't know. Shall we wait for the others to connect, or shall we just continue? Well, anyway, talking about USDT, what's important is it just fixes your just a sec. It just fixes the $100, the hypothetical $100 you have to 100 USDT coins. And USDT coins as crypto are easier converted and therefore for you cheaper converted to, let's say, Bitcoin or Ether or any other cryptocurrency and back. They are considered stable coins because they have low volatility, because you can only see some minor change in their rate when a lot of people start, let's say, selling their Bitcoins and this way getting out to USDT, or the other way around, when a lot of people start buying, let's say, Bitcoin with USDT. But the change is not as drastic as we're used to in the cryptocurrency market. USDT usually shows less than 0.1% change. And that's great, because this way you can securely store your money in that. But as I said before, this security is promised, but it's not guaranteed. We cannot really always rely on that. So far it has worked. Unfortunately, I do not even see anyone, because the room starter has gone off for some reason. Just a sec, I'll try to get it fixed. We have a question from the chat. We have a couple of questions from the chat. All right, I'll just go with the come in order. So first in, first out. Can some examples